I'm John Cook, and today I am joined by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, January 27th, 2026. Welcome back to the podcast, George.
Great to be on, as always.
Yeah, good to have you. So last time was a good one. We had you and Agron on. We reviewed the 2026 outlook. We're I don't know, a week or two later, and I suspect there's plenty that's changed given there's the quantum of news we've received between now and then. But before we get into the episode, I did want to share some exciting news with our listeners. MUFG Securities Americas, Inc. has been designated as a primary dealer by the Federal Reserve Bank of New York. This is a significant milestone that reflects the sizable investment MUFG has made in its global markets franchise and its long-standing commitment to U.S. markets generally and the U.S. Treasury market more specifically. Now, getting back to the episode, George, I'm not sure how you feel, but kind of as I was alluding to, 2026 has been filled with plenty of twists and turns, and it's January. January's not even over yet. We'll get into what's happened and if it's shifting your views, or not. But we're coming back from multiple trips, multiple travels. You and I were in D.C. and Boston. I think 2 weeks ago. You were in all over Europe last week. Visiting a ton of clients. I'd like to start there. Being a little bit more specific, I guess what I want to get at is, you have a wrap, you've been going out and talking to clients. What has resonated with them? What have they agreed with? What have they not agreed with? What are you sensing, overall from the institutional investor community as you deliver our house views and your outlook for 2026?
Thanks, John. That's a great setup. And yes, it's maybe useful to kind of recap what the view is, and listeners and our clients can go and find it on the MUFG research website. But just in general, our general view is that first half slightly stronger than typical sort of growth, that won't last. That we kind of get into the summer, into the end of the year. That we kind of get the economy decelerating again. The jobs market still is an issue for us. It's really one of our key calling cards and remains so. That we think unemployment rate is going to go higher, not lower, or stay stable, which is what the consensus is. And that inflation will grind over time down towards the Fed's target. All of this, as well as just the kind of, the calls for even lower rates coming from all corners of Washington, D.C., that there's going to be scope for a number of cuts. We have an out of consensus view of 3, maybe even 4 cuts, depending on who becomes the next Fed chair. And that's kind of our base view. And how that compares to consensus. The consensus is really, really bullish on the outlook for the economy, thinking that this is like a kind of key pivotal shift in the growth cycle, that we're going to accelerate from here, and it's going to be sustainable, that it's going to broaden out. We don't subscribe to that view. So that's the consensus view. We think it's still too isolated to the actual AI sectors as well as more narrow industries. I would say that 80% of the clients really don't subscribe to our kind of that the economy is peaking early. They think that the economy has legs. So the 20% that do agree with us, will agree more emphatically, and I think really have similar views or even stronger views than we have when it comes to the risks that are present in the economy as well as markets. So I think it's like an 80-20 split is what I would kind of suggest in terms of how people are responding to our house view. 80% don't agree or kind of push back a little bit more and have more optimistic outlook, and 20% are with us.
But the important thing is those 20% are really with you.
Exactly.
All right. So okay. So that's the broad view. That's the sentiment we're getting from the client base. I'd like to get a little bit more micro for a second. We're recording this podcast on Tuesday, the 27th, one day before the January FOMC meeting. You recently published your January FOMC preview entitled "Dovish Under Pressure." Let's go over, for benefit of our listeners, what you were expecting on Fed Day.
Yeah, this is the first Fed meeting of the new year. It's also the first meeting they're going to skip after having cut 3 times in a row last year once they pivoted towards being concerned about the jobs market like we have been. So it's going to be interesting to see, what's the sort of messaging more than anything else. Dovish under pressure. We've seen in the past, the Fed will kind of oscillate between they'll cut, but they'll sound hawkish. But then when they're not cutting, they sound dovish. And it's, for us, we still don't think there's enough information to unequivocally say that we've now seen actual job growth because we haven't really seen that yet pick up in a significant way. And we do think that Chair Powell, after flagging that it's possible that the NFP has been overstating monthly job creation by over 60,000, it's possible that he kind of reiterates that message, and that would be the dovish sort of signaling that we get from the Fed at this first meeting of the year.
But which is kind of which would be him sort of repeating himself. Like that's a view that he's held, and so him emphasizing that at this meeting would be taken dovishly. Is that correct?
Yeah, that's correct. And also, it's also ahead of that key benchmark revisions which come out at the start of February, and so since it's such a close call on it's coming up so soon, I should say, then it probably makes sense for them to be more cautious on the labor market before they have more information.
Right, and plus you get no economic projections. So this is they're not going to cut. So it's sort of maybe one of those meetings that's just not as significant. Is that the right read?
Yeah, and it's a time to reflect, and just kind of get prepared for the upcoming meetings where they may cut. And there's still a path. We have an out of consensus view that we think that they should be cutting every other meeting, which would suggest March, but the market clearly has nothing priced in for March. Mm-hmm. And there's been, and the hawks have been pretty aggressive. And we're really waiting to see both what the Fed says in this first meeting, and also that critical NFP, which will have the revisions for the benchmarks. If it's not enough to convince the Fed to cut every other meeting, then it looks like the first cut is going to be after Powell leaves. But we'll see. We don't want to prejudge, and we think the markets are a little bit, maybe too hawkish right now.
Right, and presumably we could get President Trump announcing the new Fed chair, at some point soon as well.
Yeah, exactly, and that's the other risk. I mean, it could happen at any moment. We don't really know, or it could, it could still linger into the next meeting, before the next meeting. But given all the sort of coverage and what's going on, we would anticipate it's coming up soon.
Great, thanks, George. Okay, moving on. As MUFG would be, be remiss to not discuss Japan, but also we'd be remiss to not discuss Japan because it's really what's been moving, markets globally. The JGB market got destroyed on Monday and Tuesday of last week with 40-year yields, I think, topping out, like somewhere around 4.25%, which is, probably 50 basis points higher over the course of, maybe a month or something like that. And I think they sold off 25 basis points in one day, which was nuts. We also had some serious price action in dollar yen, with the press reporting that both the Bank of Japan and the New York Fed conducted rate checks on Friday. Dollar yen has gone from, I think, about 160 to below 153. So it's been a huge move on presumably no actual intervention. So, George, you've got great Japan game. You're a keen follower. You've been working at Japanese banks for over a decade. I think our listeners would appreciate understanding what's going on there, but also what it means for us, and for the U.S. markets more specifically.
Yeah, I would say half my career has been at Japanese institutions, and clearly even before then, I've been focusing on Japan and how their rate markets just kind of evolved over the multiple lost decades, and what it meant there, and then also just the foreign flows, as I track very closely. And so Japan 100%. Is near and dear to everything that we do here, but also it's a key focus of mine as a kind of global rates bond strategist. Japan's super important, and so the moves that you described are significant. I mean, what took place last week, but what's been happening, it's been crescendoing over time. But that move was a multi-sigma move in JGBs. According to the Bloomberg sort of like the liquidity metric that they provide, Japan's Japanese bond market JGBs are less liquid than all other major sort of G4 sovereigns, which is usually it's unheard of. And if you think about, like, if you look at certain parts of the vol surface, yen swaps are in vol terms, the implieds are higher than U.S. implieds in some parts.
Which is crazy.
Yeah,
I mean, like that's like that chart. You got to include that chart in like your next monthly, because that chart has to look nuts.
Yeah. So all this stuff, it's all noteworthy and critical because it's rare and it's unusual. It's happening in such a quick pace. What's more impressive is that it hasn't really led to any sort of indications of stress per se, but the markets have reacted to it. Like, U.S. rates were under pressure, also in sympathy with the move. We did get the 10-year, towards 430 and above. As a reminder, we think that the 10-year should be trading somewhere between 3.8 and 4.4. That should be the range for the year. So we're getting dangerously close to that upper end. We still think that buying the dip makes sense in U.S. rate space, but when you get moments like this, it becomes like a liquidity vacuum. And so we think it's something that we're watching. That's super important to watch. Japan in general, plays a huge role both in in capital formation, as well as just buyers of U.S. debt over the decades, and plus just part of the global banking liquidity system. So watching closely around what's happening for the dollar plumbing, what it means for potential risks around repatriation or not, or maybe just the lack of or less buying that might happen now that JGBs are a viable alternative and attractive asset class with yields so high. So all those things are things that we're watching very closely.
Not to interrupt you, but there's an interesting article in Bloomberg about how the GPIF, the Government Pension and Investment Fund, of Japan, could reallocate assets, towards JGBs to kind of help solve some of these problems. So good example of how price action like this could drive, flows globally.
Yeah, and pretty significant shifts in flows that could have consequences for the treasury market in the sense of maybe less buying at a time where we still have large deficits. So these are obviously key things that we all watch. At a time where the U.S., especially the U.S. Administration, wants lower long-term rates to try to solve the affordability issue that's impacting households more broadly, but specifically the housing sector and the mortgage market. In many ways, what happened in the last couple of weeks unwound the spread tightening that we saw in mortgages, for example, in terms of all-in mortgage rates are now equal to or as high before that announcement of the GSEs buying mortgages. And so, what's happening in overseas markets matter is I guess is the bottom line, and we're watching it very closely. We don't think it's a Liz Truss type event. It's much bigger than that in the sense that how the role that Japan plays. I don't think it's a minor thing that you can overlook.
Yeah, the U.S., Japan's the largest holder of U.S. treasuries outside of the U.S. To that point. So and you said this earlier, but incredible the illiquidity that market experienced earlier in the week. With the liquidity in JGBs deteriorating and making them the worst. The worst. G7 bond market from a liquidity basis for the first time in a long time.
Yeah, I'll just kind of end with like recapping what some of our internal researchers think, and just my thoughts sprinkled in there too. How do you get your arms around this? I'm sure we'll talk before February 8th. There's a key election coming up in Japan. The Bank of Japan itself, the BOJ, could maybe get a little bit quicker to hike, and that could also help provide some stability both for the yen and the rates market. And so those are the things that that could engender some stability. And then we have the key March 31st end of year fiscal year for Japan institutions, which then could see a restarting of interest in fixed income markets starting in April.
Yep. Yeah. Well said. And I would be remiss to say, despite all the carnage in the Japanese government bond market, earlier last week, the market has, rallied back and with the yield curve flatter, and is sort of unwound, the lion's share of those, of that damage. So, yeah. So George, why don't we wrap it up there? I think we covered a lot of ground. And for our listeners, if you have not already, I would encourage you to check out George's January FOMC preview entitled "Dovish Under Pressure." And if you are still not receiving George and his team's strategy reports, do check out the MUFG Research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered to your inbox. Great stuff as always. Thanks for coming on the podcast.
Thank you, John, for hosting.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.